everyone, welcome back to Mindful Investing. S&P 500 is now officially entering the overbought zone. This is a really important indicator to watch for, not just for short-term traders, but for every long-term investor who's been enjoying this bull run. On the 10-year weekly chart, the RSI has crossed above 70, and history tells us this has never been a time to ignore caution. So in this video, we'll look at the 10 years of S&P 500 data, identify patterns in previous RSI peaks, and talk about how you can prepare and position yourself smartly for what might come next. So let's go back all the way to 2015 and see what happened each time the RSI on the weekly chart went above 70, which is a clear sign of extreme greed and euphoria in the market. All right, let's start with the recent one first. In 2024, there were two RSI peaks above 70. First one was when SPY fell from 523 to 492. This was roughly a 6% pullback. And the second came in July when SPY dropped from 561 to 509, about a 9% correction. This was due to the US restrictions on semiconductor exports to China. In 2023, RSI slightly crossed 70 and SPY pulled back from 456 to 408, which is around a 10% drop. This was due to the Federal Reserve kept interest rates at a 22-year high in July 2023. The possibility of more rate hikes raised concerns, and tighter economic conditions caused this drop. And in 2021, the RSI also surged into overbought territory, followed by a sideways market that lasted nearly 2 years before breaking higher. In early 2020, just before the COVID crash, RSI was at 78 and SPY plunged from 338 to 228, a 32% drop. And in 2018, RSI hit 91, one of the highest readings in the decade, which is extremely overbought, and the market corrected from 286 to 252, around a 12% decline. Across all these instances, one pattern stands out clearly. Every time RSI crosses 70 on a weekly chart, a pullback, big or small, has always followed. And when you really think about it, this pattern isn't just about charts or technical signals. It's a mirror of investor psychology. The same emotions, the same greed and fear play out again and again, decade after decade. That brings us to two powerful takeaways, lessons the market keeps teaching us until we finally learn them. Number one is when RSI enters the overbought zone, the market moves into what I call extreme greed territory. This is the phase where everything looks perfect. News headlines are optimistic, analysts are raising price targets, your portfolio is likely hitting new highs, and everywhere you look, from social media to financial TV, people are celebrating the bull run. But that's also when risk silently starts building beneath the surface, because success makes people comfortable and comfort breeds carelessness. Investors start to believe that this time is different. They increase position sizes, they buy call options, they use margin, and they convince themselves that the rally will never end. That's how overconfidence turns into overexposure. And when the first sign of volatility appears, it's already too late. The one who went all in are forced to sell, not because they want to, but because they have to. This is why I often say discipline is hardest when everything looks easy. When markets are euphoric, that's when the real investors quietly step back, build cash, and prepare for what comes next. Two is every single one of these pullbacks, no matter how deep or sudden, has always turned into a buying opportunity for those who were patient enough to wait and prepared enough to act. Corrections are not your enemy. They are your discount season, but only if you have the cash and the courage to take advantage of them. Think about it. The same people who panic during pullbacks are often the ones who were over invested at the top. Meanwhile, those who built cash, who stayed calm, and who understood the bigger picture, they are the ones who buy when everyone is fearful. And that's where wealth quietly transfers from the emotional to the disciplined. That's exactly why when I see SPY entering into these overbought levels, I personally start preparing ahead of time. I start to build up my cash position because cash is not a dead money. It's a future opportunity waiting to be used. Take partial profits on my short-term or swing trades, locking in gains before the crowd starts selling, and review my portfolio, separating long-term conviction holdings that I want to hold through any cycle from short-term trades that don't deserve to be carried into volatility. It's not about timing the market perfectly. It's about aligning your mindset, knowing when to be aggressive and when to step back and let the market come to you. Another important thing to notice is the market has already given over 20% annualized returns on average over the last 3 years. That's not normal, that's extraordinary. So don't let euphoria take over. Go through every stock you hold. Ask yourself which of these are solid companies with strong free cash flow, healthy balance sheets, and sustainable growth. Because when the next correction comes, only fundamentally strong companies will survive and bounce back stronger. As for me, I'll be trimming some of my high gainers, locking in profits and accumulating cash, not out of fear, but out of discipline. Remember, markets don't reward greed, they reward patience, preparation, and rational thinking. So, what do you think? Do you believe SPY's current momentum will continue, or are we due for another healthy correction? Share your thoughts in the comments below. I'd love to hear your perspective. And if you found this video helpful, don't forget to like, subscribe, and turn on notifications so you don't miss my future updates. Until then, stay calm, stay disciplined, and as always, invest mindfully. Thanks for watching, and I'll see you in the next one.